Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, July 11, 2017. Looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And we had a flat day today, nothing going on in the market for the most part. The Spider finished up a dime, and that's a flat day, that's a rounding error. So nothing going on. So we still have essentially the same thing that we had from yesterday, which is we have this bearish pattern going on. So it's basically a bearish wedge pattern that will generally play out to the downside. However, I'm going to give you an opinion. This is not necessarily as much technical analysis as it is an opinion just based on this week's activity and what I think is going to happen leading into the earnings season that really gets underway beginning Friday with JP Morgan earnings. And then after that, you have some more bank stocks, and then everything really gets going the following week and then and beyond. And they'll last for several weeks, and the earnings will come fast and furious. And that has a tendency to have a pickup in volatility to the market. So we'll talk about that as the days go on. But what I think is going to happen over the next few days is I think we're going to have a lift in the market, not necessarily a tremendous rally, but I think we're going to have a rally leading into the JP Morgan earnings. Why is that? Well, there's a couple of reasons why, and again, this is more my personal analysis, personal opinion. It's not that I'm looking at a chart giving you this information. I'm telling you what I think is going to happen, so take it for what it's worth. It's definitely worth a grain of salt. So right now we're trapped in between the 20 and the 50 period moving average. So the market obviously has some overhead resistance, and then there's some more overhead resistance at this red candle high. So there's definitely overhead resistance in the market. You have what I believe begins tomorrow and will last 2 days, or potentially just one day. I'm not 100% sure. I didn't really look it up, nor do I care. But you have Janet Yellen giving what was always known as the Humphrey Hawkins testimony. Whether they still call it that or not, I'm not sure. But she basically is testifying in front of Congress about the Fed and the economy and how good everything is and all that stuff. And that is what she's going to say. She's going to say, you know, we have an improving economy, and everything she says is by a script, and it's all going to be from a positive perspective. That's just the way it is. That's the way it goes. The Fed chair will never, ever speak negatively unless there's some crazy stuff going on. So that in and of itself should give somewhat of solace to the markets, if I can use that word. And I think that's going to help. It's not the catalyst, but it's going to help give a lift to the markets. You have JP Morgan earnings on Friday. I wouldn't be surprised to see the market rally up into that particular time frame. I had given you before the 13th of July, which is an important date, okay? Now, I'm not suggesting the market's going to turn on a dime on the 13th. I just think that's when we really need to be keenly aware of market volatility pickup from that point forward, and anything that from a technical perspective would give us reason to believe the market is beginning to break down. So now we're really in the time zone where I have to pay very, very close attention to all the technical attributes and aspects of the market. Last night, we also discussed institutional distribution and how the institutions will distribute stock to the retail investor, the individual investor. That's who they're distributing it to. So if the institutions are looking to unload stocks, then it's really the need. They have the need for the market to continue higher a little bit, right? It's very difficult for them to distribute stocks distribute stock in a downtrending market. So they really need the market to have a little bit of a lift. We also have options expiration week next week, when more of the bank earnings will come out and others. So the expectation that I have is volatility will certainly pick up into next week or throughout next week. So I kind of list all these things on a list or on a piece of paper, and they're puzzle pieces. And you know how I like to talk about puzzle pieces. I like to say, all the data that I have, all the information I have, all the evidence that I can conjure up, I put them on the table, and they're all together a puzzle. The question is, can we put together the pieces to the puzzle that gives us the best indication of what's going to happen next across the markets? So I take all the stuff I just discussed, which is non-technical in nature, and I put it on the table and I say, you know what? I've read this book before. I've seen this so many times. I mean, like dozens of times would be an understatement. And I just get this feeling, and this is really what it is. It's a feeling that the market's going to have another push higher into the end of the week. All right, so all that being said, where does that take the market? Am I talking about all-time new highs and keep going, or what's the number I'm talking about? Well, as it stands now, they're going to take a run, in my opinion, for this red candle high that comes in at 243.72. It's not a tremendous distance from where we are, but it's a fair amount from where we are. If you translate that into S&P points, that's roughly 15 S&P handles, give or take. And I'm not suggesting they're going to stop short at that number. They can certainly pierce through it by a little bit. But I'm not so sure they're going to be able to close a day above that level, certainly on the first run. So a pierce above it, no problem. 244 is a round number. That seems to be the most logical place for the market to want to get to. If I'm right and we have a spike higher, the question will be, where can they close the market? And you know, I say this all the time. It's not really how they trade them as much as it is how they close them. Now, if I'm wrong and I just made all that up in my mind and it's all or becomes meaningless, then what's the alternative? Well, the alternative is what I started this particular analysis out with, which is we do have a bearish pattern. And until and unless we can really get above the 20-period moving average, then this is a bearish pattern, and that's the way it is. So we can certainly play out to the downside. But I just don't think that's the case, at least for the next few days. And that's all I'm really talking about right now is the next few days. So we'll just call it the next 2 or 3 trading sessions, Wednesday to Thursday or even into Friday. Now, if JP Morgan's earnings are perceived good, and that's Friday morning, then we can certainly continue a rally through Friday. That's certainly a possibility, but it's way too premature to start talking about that. Last note that I'll make on the S&P or SPY is, notice where today's low is. Today's low came within a stone's throw of the 240.75. Came down, did another test of that level, and immediately reversed off that area. Here's a 10-minute chart. Look what happened. We came within just a few pennies, making a low of 240.85, 10 cents away, and look at how fast that reversal came. That was basically a market that turned on a dime away from that price zone. Anybody think that that price level down here is important? I do. And by the way, when you take a look at the hourly chart, this is a rough trend line. We've pierced through it over here, and it's not 100% perfect, but it is a trend line that the market seems to be respecting. So when that happens and the market draws in the trend line, it's not me drawing the trend line, it's the market drawing the trend line, I think it's important. So my take is that if we get above this trend line on an hourly closing basis and we confirm above, which would mean in my book a couple of hours closing above there, namely a close above the previous hour's close, then I think the market's going to have legs to the upside, and I think we'll start to work our way up to that 244 level, maybe even up here to 244.5. We'll see. Too premature right now, but that's the way I see the market unfolding. So I thought this was just interesting information to pass along to you. Mainly, I like to give you what the market is telling us from a technical perspective. And that's the way we have to trade it and invest in it. However, from time to time, I don't mind telling you what I think, as long as you know it's what I think and has to be taken for what it is. It's what I think. And keep in mind, I never trade based on what I think. I just trade based on what the charts tell me. And when you look at, and by the way, go back over to the weekly chart just so we can put this in perspective. Let me get rid of this line. The chart is telling me that this is bullish and that we are poised for a break higher, and we are in the time zone where the weekly chart should break higher. nobody should be surprised from a weekly chart perspective if we start higher. This is the 7th week in a row we've been going sideways. We're now getting into the zone where the market has the propensity to break higher. So we shouldn't be expected if that happens. So all these things combined are the reasons why I gave you my opinion from a technical perspective. As you know, there's really nothing wrong from a long-term perspective with this market. Now maybe, and I'm fast forwarding a little bit, but maybe at higher levels the market does give us some kind of a reversal signal. We'll see. Obviously, way too early to say that, but this could be an interesting recipe for that to take place. Looking over at the IWM today, the IWM was certainly the standout market along with the NASDAQ. They were both up today. Everything else was mainly flat. And the IWM was telling us that higher prices are coming. It's obviously making a bearish pattern. That's not lost on me. You have a down move, and you have this sideways consolidation in a bearish formation, and that'll generally lead to lower prices. But then again, we'll see if my other thesis is correct. So other than the fact that the the IWM was up 1/3% today, not a lot going on. The volume today across the markets was again extremely light. There was only about 50 million shares traded, slightly less than that in the Spider. And as you can see, the IWM clocked in at less than 16 million shares against an average daily volume of 27. So when we do have light volume, the path of least resistance also tends to be to the upside. So I'm not going to make a tremendous deal out of the IWM higher today than the Spider, and also the NASDAQ was also up about almost 1/3% today. The NASDAQ Composite was up 17 points today, 1/3%. Here's the transports, and what would a market be without a divergence, right? I have two favorite leading indicators. One was up and one was down today, and that's just apropos. Why would the market make it easy for me to make any decisions based on everything pointed in the same direction? Well, that's the way the market is. It's designed to make as many people look like fools, or fool as many people as much of the time as possible. And part of my job is not to get fooled, even though obviously we all get fooled at times. So with the transports down 74 points today, or 0.75%, that's just a down day in my book. I'm not going to read too much into it yet. Maybe it's an indication of something more unfolding. That's certainly possible. I'm not going to rule that out. I just think it's a down day. I mean, we could certainly be consolidating in this upper range here. If tomorrow's an up day, then all this was a down day, and this is just consolidation in the upper range. We're at new highs. So when we're at new highs and you have a down day, it's just selling, right? It's just profit taking, or at least it could be. That's all it is. So I've got it in my book. It's of note. It's a puzzle piece on the table. However, I don't think it changes my overall, and I remain cautious, and I'm telling you this on purpose, my opinion that the market's going to go higher over the next few days. We'll see how it works out, and we'll obviously discuss it tomorrow night and beyond. Let's go over to the gold market. So gold had another tiny update today after making some kind of a low yesterday. And what we seem to be doing is making a bearish pattern in this range. Now, whether or not gold is carving out a bottom or not here remains to be seen. And we're not going to know definitively at minimum unless gold can get above this red candle high, which comes in at 1228.10. 1228.10. Until and unless that happens, this is a bearish pattern. And you saw what happened last time we did one of these two-day rallies, or 2-day moves off of a big red candle down. We had another one. So we'll see. I'm not convinced one way or the other. There's a no trade here for me in the gold market. I'm just not seeing anything that looks like it wants to, or it looks like it's making me have a bullish or a bearish opinion one way or the other. I'm just going to let it happen, and when gold tells me it's ready to do one thing or another, I'll let you know. But right now, I don't have anything definitive on the long or the short side in the gold market. We talked about it going lower once it made this bearish pattern. So we had a down move, We had a bearish pattern, and we talked about a down move. We talked about that trend line wasn't going to hold, and that's fine. But from here, where we are right now, I'm not convinced one way or the other whether or not we have to go break 1200 or the low was seen at around 12, whatever the low was, 1204. That is a possibility, but we just need more evidence to make that determination. Silver, same deal. Now, silver put in a tail candle yesterday, so there's more evidence that a low might be in silver. And, you know, we had some kind of a retrace today, and we talk about it all the time when this happens. That's your spot, right? When you see a retrace, you can trade it long against yesterday's low, and that turned out to be okay so far. So there's more evidence that we've got silver carving out a low than gold, and they'll generally trade together, not all day, every day, not day by day, but for the most part, you know, in the bigger picture, they do trade together. So if one's carving out a bottom, then the other is bound to be doing the same. Pretty cut and dry in silver. We can move on to crude oil. And crude oil is actually spiking higher as we speak. There was one of the inventory numbers just reported, and it looks like it's going to get to, or want to get to, 46 to 46 and a quarter, in that neighborhood. That's about where it should stall out. But the bigger picture is, this is what we were discussing. We had the A leg, the B leg, and a possible C leg of an ABC pattern developing. This would complete once we got above the A leg. And that's what I think is developing. That's what my suspicion was telling me over the last couple of days as we've been talking about the ABC corrective pattern. And that's where we are. And it looks like crude oil right now as we speak, as it's spiking. And I'll show you the shorter time frame here. We can look at the 10-minute chart. You can see here it's spiking as we speak. And it looks like it wants to, at least to me, get to the 46, 46 and a quarter area. You can see it more clearly on the 60-minute chart. You see this red candle, breakdown candle, has a high of 46.18. So they're going to want to test that level, whether it comes up, you know, 10 or 20 cents short or pierces it by a couple of pennies. Either way, this is an area where it's not going to just run through and continue going. You're going to get some kind of a reaction at that level and the downward direction at 46, 46 and a quarter. So that's where we are in crude oil. If we close above this level, if we close above this red candle high, then we go to the next level, and the next level, which is obvious, a pivot high, comes in at 46.53, and that's a, you know, call it a midway point in between two even numbers. Crude oil, more than most anything else, likes those even numbers and the halfway numbers. They'll typically have price reactions in crude oil, 46, 46 and a half, 47, 47 and a half. More often than not, you see that crude oil respects those even and even the midway, meaning the halfway point numbers. If you're a crude oil trader, you've seen that time and time again. If you're not, then it's mainly meaningless. So back on the daily chart, ABC corrective pattern looks to be unfolding and in the beginning, or not even the beginning stages, but in the middle stages of completing the ABC or the C leg. Looking over at the bond market, we're just going sideways here. The more we go sideways in the bond market, the more likely it is that we're probably building a bearish pattern to go lower, but it needs more time to develop. So if this goes sideways for another 2, 3, 4 days, then I would suggest that the odds favor another push down is coming. That will be off the table if we can get above and close above the 50-period moving average, but more importantly, really this trend line. And I'm going to leave this trend line on there because if we got above that trend line, I would suggest that we're poised for higher prices in the bond market. Until and unless we do, then this is a bearish pattern that will generally play out to the downside. But it needs more time, so my indication would be that we're going to go sideways for another couple of days, banter back and forth, maybe get a little volatility around Janet Yellen's speech in front of Congress tomorrow, and we'll see what happens. But this looks to be a bearish pattern developing in the bond market. Not a lot you can do with that. Needs more time to develop. And we'll go over to the dollar. Saw a little bit of a downtick in the dollar today. Where did we go? We came in to do a kiss of, or a test of, the lower portion of this trend channel and bounced off it a little bit. But again, long and wrong. Just need more time in the dollar. Long-term bullish, short-term, we really have to hold this green candle low that comes in at 95.385. If that doesn't happen, if we don't hold that low, then we're going to have to go back to the calculator and come up with some new levels on the downside in the dollar. So far, as long as we hold the bottom portion of the trend channel, then it's okay for the time being. And with that, I'm going to wrap it there tonight. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.